Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek, insight from the reporters and editors that bring you America's most trusted business magazine. Plus, global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
Hi, everyone. Welcome to the weekend edition of Bloomberg Businessweek. It's definitely been a wild week in global markets, politics, and geopolitics, and really in thinking around whether American exceptionalism is still a thing. President Trump addressed Congress. Tariffs against Canada, Mexico, and China went into effect, then some were delayed. Broadcom earnings surprised to the upside, reassuring investors that the AI spend remains healthy. And we got a gut check on the U.S. economy with the Friday jobs report, which was mixed. Steady hiring, but a higher unemployment rate. All of the details can be found on the Bloomberg and at Bloomberg.com.
Speaking of gut checks, Carol, we got a great one this week on the investment environment by spending time in the heart of New York's financial district at Bloomberg Invest. It's our annual live event, and it unites leaders in asset management, banking, wealth, and private markets.
We're going to bring you some of our conversations with those managing billions of dollars in the public and private markets and who have a front row seat when it comes to the investment environment.
Including the president of the NYSE group on whether an IPO boom is coming. Also, New York Fed President John Williams talks tariffs and inflation.
Plus, a couple of conversations that brought tech and the investing world together, as Dell's chief AI officer gives us a reality check on the AI spend. And then speaking of AI, we'll hear from SigTech founder and CEO Bin Ren. His company provides an AI agent for financial services firms.
First up, one of the discussions from the stage of Bloomberg Invest. Carol, you had a chance to talk to Lynn Martin, president of the NYSE group. You guys talked about what some could say, perhaps maybe a boom in IPOs this year.
Our chat happened on Tuesday, beginning just as markets opened and were selling off on tariff concerns. She reminded us not to panic.
Remember that the S&P and the Dow in particular are still above the pre-election levels. So remember, there was a big euphoria that occurred post-election day in the market. So,
which was maybe overdone at that point?
Potentially.
Yeah.
Potentially. I mean, markets recalibrate.
So I was thinking about CoreWeave, backed by NVIDIA, cloud computing provider. They filed for an IPO. Bloomberg reporting it could raise $4 billion from the listing. It's expected to target a valuation greater than $35 billion. We are expecting kind of a wave of potentially sizable listings this year. On a day when the market sold off, it was the worst sell-off so far this year. What was more interesting to you? Was it the sell-off or the CoreWeave listing?
So what you will see now are companies start to flip public. But it's a timing thing. What most people don't appreciate is if you're a private company, your financials go stale at some point, so you need to restate financials. That's what happens between sort of that mid-February to end of February when you get your audited financials for the previous business year. So I anticipate, based on our pipeline, we're going to start to see some companies flip public. We had one flip public called Mountain.
Are you hearing from companies? You're busy.
Yeah, we are busy. We're busy, not just from the perspective of working with our pipeline to actually get them out the door, so in execution mode. But also we're very busy in terms of pitches.
Are you
where companies are, making plans? They're making plans for more like second half.
Sizable ones, smaller ones?
Yeah, decent sized ones, mix of both.
Now, are you worried though about our world is day to day, where whatever comes out of Washington, whatever executive order, whatever press event happens from the Oval Office, because it moves markets? Are you concerned about what you're hearing now and what seems to be optimism for IPOs, that could get derailed?
The only way that I think it's going to get derailed is if the volatility in the market becomes outsized. And I don't think it'll get derailed.
We've moved up a little bit, but...
We've moved up a little bit, but, a VIX around 20 is still fine.
So is there something, though, the president could do?
I don't know. He seems to be very focused on three key areas, or this administration's focused on three key areas: border security, resolving the wars that have sadly overtaken other nations, and our economy. And what you're seeing right now is the confluence of all three. come into the fore and start to affect policy.
It's a lot.
Yeah, it is.
What about the rate environment? Because we have seen the U.S. Treasury curve move down significantly. It's been interesting the last few days. If we see that move down, I guess there's a couple scenarios, right? Moving down without a recession, better, especially for the IPO market. Tell me some of the other factors that you think about that will determine what happens this year.
Well, I mean, if you also look at the rate environment, that's going to affect mortgages, it's going to affect loans, it's going to affect other parts of the ecosystem. You look at the bank stocks, for example, they're doing quite well at the moment. That's probably more to do with promises on the regulatory side as opposed to the interest rate side. But there are a variety of other parts of the ecosystem that would benefit from a lower rate environment. So we'll see.
What do you think about the private equity world in terms of finally looking to spin out some of their investments?
Yeah.
It's not been an easy environment. We know that Carlyle telling Reuters, we're looking maybe for $4 billion worth of investments coming out. What are you hearing, or what are your expectations? Do we finally see some of the private equity investors somehow, either IPO, selling assets? What do you expect?
Yeah, we've seen a couple of sponsor-backed deals go out last year. Actually, Standard Aero was one that did particularly well. That was a Carlyle deal that did particularly well in October of last year, raising north of $1 billion and trading really well in the secondary market. I think the more deals that get done at good valuations and raise good amounts of capital, and then importantly trade well in the secondary market, given the liquidity and demand from investors, I think you'll start to see some of the sponsors start to float their aged assets or look to the M&A markets. So it's not just about IPOs.
Right.
This administration's also promising a more favorable M&A environment, which is another area that's attractive to sponsors.
Lynn, one thing I wanted to ask you, Bloomberg reporting about a couple of weeks ago how 3 of the U.S.'s 4 largest IPOs this year have traded below their offer price in their first session. So many would consider that black.
It's been a quiet though.
Does that tell you that they shouldn't have gone public, that they went too soon?
No, I think there's just a question on the valuations maybe, but sometimes that happens.
Yeah.
First of all, there's been very few deals that have gone. We've had a couple of deals that have done really well. If you look at Flowco and Carmen, space and defense, those are in industries that are very attractive to investors at the moment. They've done really well. It's a bit of an art that the bankers have to do, though, figure out the right valuation mixed with investor demand. The companies that are trading below, they haven't had their first earnings calls yet. I mean, let's see where.
You're saying be patient a little bit?
Yeah, it's not an instantaneous. It's not an instantaneous judgment on a company. Let's see how some of those companies do, particularly like a Venture Global, who's really well positioned in the LNG markets and all the infrastructure moves that are taking place in this country.
We've got 2 minutes. There's 2 things I want to ask you. In 2021, the U.S. IPO market hit a record high. There are some expectations that we could get back to pre-pandemic level. On the record, do you think we could get there this year?
I think 2021 is an anomaly. I think 2022 is an anomaly. I think those are 2 ends of the bell curve.
Yeah.
Positive and negative when you consider, depending on what your perspective is on 21 and 22. I think we'll get back to a more normal IPO environment where companies raise an aggregate about $50 billion, and there's a good number that actually go out. We would have gotten there last year, I think, if we didn't have a pause in the summer, which we saw, which was all sparked by the election and uncertainty around the election. So if you had asked me last May or June, I thought we were on pace for a pretty normal IPO year for 24. Right. So I think we'll get there in 25.
The other thing I've got to ask you, there's so much money in the private world. Anthropic closing a deal to raise $3.5 billion at a valuation of $61.5 billion. OpenAI, meantime, currently in talks to raise $40 billion. SoftBank, other investors for an even larger $300 billion valuation. I could go on and on. How does that hold back the IPO market? That especially, I don't know, is it just the AI world that is able to tap it in your view?
I think when a company comes out, they are more ready to be a public company. By more ready to be a public company, I mean you've got durable growth. You can articulate a very clear strategy, a very disciplined P&L.
So this is a good thing?
I think it's a good thing. I think the private markets and the public markets have to work in concert.
All right, so we have 13 seconds. This is what we call a super rapid round. Okay, what's the most optimistic view for the IPO market this year?
Most optimistic IPO, I think you're going to have a normal environment. Last year, if I look at the companies, the most important thing that I look at is the secondary market for IPOs. Yeah. Companies that listed on the New York Stock Exchange traded 58% above their IPO price. So I think we're going to hopefully see that type of growth in the secondary, just post-IPO market this year.
All right, last question, the flip side to that is what's the biggest risk?
So the biggest risk is volatility, the things that are unexpected that happen in the market from time to time. I don't have a crystal ball. I don't know what that's going to be. Unfortunately, I don't know what's going to cause that unexpected shock. But I think the market does recognize those three pillars: resolving geopolitical conflict, border security, and focusing on a strong domestic economy. So as long as the administration stays within those three pillars, I don't know that there's much that's going to derail things.
But the risk sounds like it'll come from Washington.
I actually have no idea. Okay. It could be, I mean, you look at something like DeepSeek. I heard the folks right before, the panel right before this talk about DeepSeek. That was a big surprise that caused the market to react pretty negatively when those when those usage numbers came out. That has nothing to do with anything that's happening in D.C.
Our thanks to Lynn Martin, president of the NYSE Group, in a panel discussion with Carol at Bloomberg Invest in New York City. A couple of days after that chat, we got the news that Klarna is said to be seeking to raise at least $1 billion in an IPO. That's according to people familiar.
Coming up, there are Fed speakers, and then there are Fed speakers. Chair Jay Powell, of course, anytime he talks, we are all sitting up a little bit straighter listening to what he has to say. And then there's also the president of the New York Fed.
That is John Williams, who talks tariffs and more when Bloomberg Businessweek continues. This is Bloomberg.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business App. Or watch us live on YouTube.
More of our highlights from Bloomberg Invest in New York City this past week. The event gathers allocators, deal makers, and investors from across the globe to track, dissect, and navigate the markets with the industry's most influential voices.
And safe to say, among those that markets and investors watch the most, the Federal Reserve, and a key voting member of the U.S. Central Bank's Policy Setting Committee, the president of the New York Fed, John Williams.
He spoke with Bloomberg News international economics and policy correspondent Michael McKee about President Donald Trump's tariffs and their possible impact on inflation.
You know, when you look at the research that looks at the effects of tariffs on the U.S. economy, you know, one of the things that's highlighted, it depends whether it's consumer goods, it depends on whether it's goods that lots of countries produce, and a lot of things like that. So, you know, it really made sense to let's wait and see, find out more about what policies may be put in place, and then kind of, you know, come to, I would say, you know, conditional judgments about what does it mean for the U.S. economy. And as you said, we are seeing more actual actions on tariffs in different dimensions. I would still highlight there's a lot of uncertainty. We don't know how long the tariffs will apply. We don't know what other countries may do in response to this. We also don't know what else may happen in this, you know, in the kind of realm of trade policy. You know, my own view is that, based on experience from previous episodes, based on analysis, is that, you know, tariffs on consumer goods, especially, they do feed into import prices pretty strongly. That does filter in to prices that consumers pay. That happens relatively soon. Tariffs that feed into kind of intermediate inputs, the things that companies use to make other things and to make other things, those tend to pass through more gradually and have maybe last a little bit longer in terms of effects. My view is that, based on what we know today, given all the uncertainties around that, I do factor in some effects of tariffs now on inflation, on prices, because I think we will see some of those effects later this year. Not yet, but maybe later this year. You have to factor in how does that affect economic activity, decisions by businesses to invest, consumers to spend. And that's where I think another big uncertainty is. We've seen some kind of movements in the data in the last couple of months. I think some of that's in anticipation of tariffs, so it's hard to really read the tea leaves there. But that's something else I'll be watching carefully, is to what extent is that affecting consumer confidence, business confidence, the uncertainty around this and the effects of the tariffs on economic growth and employment and things like that. So still a lot of uncertainty, I think directionally, somewhat higher prices in the outlook, at least in my kind of thinking about what's happening, but also a lot of uncertainty about how the economy responds to this.
That was John Williams, president of the Federal Reserve Bank of New York. We had a chance, too, to catch up with Bloomberg's Mike McKee after his conversation with Williams at Bloomberg Invest.
They've been very circumspect about it all, trying to stay out of it and telling us we have to wait and see what they're going to do. But now there's enough information out there that apparently they're ready to start saying this is going to be an inflation issue. Now, as John pointed out, we don't know yet how much of one. He said pass-through to consumers would be fairly strong, especially for finished goods. And then it's a little harder to know in the intermediate goods area how much of that gets passed along and how fast, but that there would be more inflation from this. And that didn't suggest to me like he's in any hurry to cut interest rates unless we see the economy collapse.
Is he worried about economic growth?
He's not worried about economic growth going into all of this because the economy was in very good shape coming into the year. What he isn't sure about is where we go from here. What kind of effect is this going to have? And he mentioned, we talked about consumer confidence. And if confidence evaporates, then you've got a real problem in the economy. And it's something he said we have to watch closely.
What about when it comes to independence of the Federal Reserve?
He said he wasn't worried about it. Obviously, the Fed continuously says an independent central bank is important because that's when you can do monetary policy best.
Doge hasn't really made its way into the Fed.
I've been asking around at various Fed banks, and no 20-somethings with computer coding stuff have come into the banks. They are set up legally a little different from most government agencies. So it appears that Doge might not have access to the Federal Reserve. And I don't think that even if they did come in there, they'd let them into the computer systems.
That would be kind of interesting. But anyway, anything that surprised you in your conversation with John Williams up on stage? I mean, they tend to be very careful, right? And
right. Well, not a surprise, but he did say that there's no need to change rates now. I asked him if what he was saying about uncertainty and we have to wait to find out what happens, if that meant that they were not going to change rates on March 19th, then he basically said yes, there's no reason to do that right now. The economy's in a good place, monetary policy's in a good place, and we don't have an idea of what is going to happen.
But if we do know now that tariffs have been imposed on Mexico and Canada, and prices indeed do go higher, and perhaps we see some inflationary effects from that, how does that change the outlook for the Fed this year?
Well, it all depends on, and I'm going to sound like an economist here, it all depends on how all this comes through to the economy. Because if there are one-off tariffs, if Donald Trump changes his mind tomorrow and takes them off or something like that, or if we just have this wall of tariffs hit now, it'll raise prices. But then prices will stop going up because they went up once. So that's not an inflation issue that the Fed needs to react to because higher interest rates aren't going to change the price level. So that's what they need to figure out. Now, the way Trump has talked about putting on tariffs with tariffs going on today, tariffs going on next week, tariffs going on April 2nd, that could create more of an inflation issue because you're continually adding higher prices to the mix. Obviously, Americans aren't going to be happy about paying more at the grocery store, and they're not going to be happy about paying more for gasoline. I don't know if you noticed that the gas buddy guy said in the Northeast, for our Boston listeners, that they could go up 40 cents a gallon this week. So
explain how that works with oil prices falling. on a day like today?
Well, oil prices are only one component of all this. There's the refining issues, and then oil prices we talk about in a generic sense, West Texas Intermediate, but all these refineries use different grades of oil. And in the Northeast, there's a lot of a heavier oil you get from Canada and some other places. And if that's going to go up in price, then that's going to increase the cost of the refiners, and they're going to pass that along to you.
Somebody like Donald Trump would say it's an example of why we should be using energy that is produced here in the United States.
Except that there's, the energy we produce in the United States differs all over the place. Now, the Bakken shale up in North Dakota is more similar to the heavy crude we get from Canada, but the stuff we're getting from Texas, as they like to say, is light sweet crude.
Yeah.
Nice name. It's like a George Carlin thing. Nice name.
It's the name of Joe Weisenthal's band.
Exactly.
Light sweet crude.
And that's a completely different kind of oil, and the refiners, different refiners can't use these different oils. So it's going to be a price question, and energy is going to be one of the first areas to feel it.
Mike, you talked about, if we continue to see more tariffs being imposed, that would be tougher on the economy. I mean, I am thinking about what we've got right now. Can the U.S. economy, is it strong enough to kind of manage, if this is it, manage it?
When you go to the gas station and you have to pay more money, how are you going to react? That's really the question here, because recession is a confidence issue.
Yeah.
If people feel that things are going to go badly, or that prices are going to go way up, or they might lose their jobs, then they stop spending and they start holding on to the money, and then companies are making less, and then they're hiring less, and you get into a recessionary spiral. We haven't seen one like that in a long time, because the last couple of recessions have been basically finance-based now, and the COVID was its own generic thing. But the traditional kind of recession could come along. We can't rule that out. So it's something you want to keep an eye on the confidence figures, and then watch what people do. Do they keep spending, or does that slow down?
Can I just say a little informal Twitter survey?
Oh.
Like, are you spending or holding back? And more people said that they're holding back. I'm not saying that this is
that's a
good sample, or but it's just interesting to see. I'm hearing that from people.
Last week we had the PCE spending report. The savings rate went way up. And people spent less money. The savings, the spending levels went way down. So at this point, it looks like people are maybe pulling back now. Is that a 1 month thing, or does that continue?
Yet John Williams still telling you the U.S. economy is in a good place.
Well, it came into the year in a good place, and people were feeling good. We spent a lot of money over the holidays, and companies had plans for capital investments, and now everybody's kind of sitting back and going, wait, let's see what's going to happen. Now, does that translate into, okay, we better stop? Or does that okay, we can live with this and get back to what we were doing?
Mike, you have reported on so many different economic cycles. And yes, there are those extreme cases like the Great Financial Crisis or a pandemic where, everything just kind of falls off a cliff. Having said that, I feel like 2 weeks ago or 3 weeks ago, we weren't even using the word recession in a conversation. And all of a sudden we are. And again, I know you talk about the importance of sentiment, but as someone who sees cycles, when we start to talk about it, does it necessarily mean that, okay, it's more likely that people are starting to, you know what I mean? If they're starting to talk about it and it's part of their considerations.
It probably is a little bit more likely. As they say, Wall Street has predicted 7 of the last 3 recessions. It doesn't mean it doesn't mean it's going to happen, but it is something you want to keep an eye on. And we've had some backup to this, the weaker spending reports, and then the Atlanta Fed GDP now, which people completely misunderstand what it is. It's not a forecast for what GDP is. It's like, given the data we have today, it's a snapshot in time.
Yeah, it is called GDP now.
Yeah,
right. Which is why it moves around so much.
Yeah, and it moves around tremendously through the entire quarter.
Yeah.
But that got into people's minds on Wall Street, and then it starts to scare people, and then they start writing about it, and then people are reading about it, and then they start thinking about it.
Hey, one thing we haven't gotten a chance to talk to you about is what Washington, D.C. looks like in the wake of the Doge cuts. Just anecdotally speaking, heard of a guy down there who did lose his job just in the wake of what's happening. And he's essentially saying that in his neighborhood, half the families are now one income parents because of job cuts just in the last few months.
I was just down there yesterday, and I can tell you, I lived in Washington for 20 years, and it's the most depressing place right now. Everybody is down. Everybody is nervous and tense. Even if you have a job and you don't think you're going to lose it, you're worried about what the overall impact is going to be. And a lot of it is not just because people are getting fired, but because there's all this uncertainty about what's going to happen. The sword of Damocles is hanging over so many people.
Right.
And so it's not a fun place at the moment.
That was Michael McKee, Bloomberg News international economics and policy correspondent. Be sure to check out Mike's full conversation with John Williams. Find that on the Bloomberg and at Bloomberg.com.
Still ahead on Bloomberg Business Week, a peek into the world of private markets and private credit with the global head of wealth management at Ares Management.
This is Bloomberg.
This is the Bloomberg Business Week podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business App. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We continue with highlights from our coverage of Bloomberg Invest, held in downtown New York City this past week. Now, we talk often about how the public markets still trump the private markets when it comes to size. But it's hard to ignore the growth that we've seen in areas such as private credit, which grew to about $1.6 trillion last year from $452 billion just 10 years ago.
Ares Management knows a thing or two about private credit, having been involved in the market for a quarter of a century. The publicly held global alternative investment manager, with an approximately $53 billion market cap, has $484 billion in assets under management.
Which is why we wanted to talk with Raj Danda, Global Head of Wealth Management at Ares Wealth Management Solutions. He joined us at Bloomberg Invest.
The advisors we talk to and their clients are really frustrated by this type of volatility. You know, we're essentially where we were, in early November,
right,
in the public markets, and that backdrop makes it really hard to work diligently on a portfolio that has above, at or above target returns. And at the end of the day, individuals have almost as much wealth as institutional clients. They've just never had the access to the private markets, and that's starting to change. A lot of our discussion is not just should they invest in the private markets, but it's how. Mm-hmm. All that said, a day like today is distracting at a minimum because most of our clients still have 80 or 90% in the markets, and the headlines and the volatility are going to certainly be a distraction at a minimum.
So would you say that, yes, today is a poster child certainly of why people invest in privates, but would you say it's also a reason why people should consider allocating more of their portfolios to privates?
I would, and I think the investment thesis is what really comes out at a time like this. We're quite clear that the private markets are illiquid. That's why you get a higher risk-adjusted return.
Yeah, you can't just call up and sell when you want to.
And the top advisors that we work with will tell you that keeping their clients invested can be challenging, particularly, again, at times like this. But the private markets in 20 years have changed completely in terms of the breadth of solutions. You can invest in sports and media assets. You can invest in real estate and infrastructure. You can have some durable income solutions from private credit. So the way we think about it is you should have equity exposure. You can do that in both the public and the fixed income markets.
Right.
You should have some kind of credit or income. You can do that in public and private markets. And then you should have some real assets. You should own some real estate. You should own some form of infrastructure as a really tax efficient solution. And you can do all of that in both the public and private markets. You couldn't do that 20 years ago, even 10 years ago.
I am curious, we're so Washington focused right now, and you can understand why, right? Because there's so much that's coming down, and some of it does impact the markets. What I'm curious about is when it comes to private markets, are there constructive conversations you guys are yet having with the administration or that you think have to be had when it comes to private markets?
There are certainly conversations to have with any administration around the evolution of the private markets and how to make it easier to invest in the private markets. Ares has been in business for over 25 years, and so we've worked with many administrations. This one is just getting their feet on the ground. It's early. They're certainly pro-growth and pro-business, and so some of that narrative we support and are happy about. But I would say they haven't yet really dug in on the type of change that would have a day-to-day impact on what we're doing.
What would you like to see in terms of what happens for oversight in terms of private markets? You and I talked ahead of this conversation, and one of the issues is the transparency issues. And I know you talked about what you guys do in terms of, I guess, spreading around risk, right? It's not like you're one investment in one particular investment when it's the private markets. It's multiple investments. But what do you think needs to be government oversight or what? You provide transparency to your investors, but does there need to be something more?
Well, I'd step back because you're getting at something that's sort of paramount to any type of investment approach, which is manager selection and the diligence that goes into an investment firm's track record. And so as the private markets grow and as there's a significant amount of new entrants, there are going to be firms that may not have a 25-year track record or may not be able to speak to prior periods, whether it was the GFC or the emerging markets or other challenging times. So we definitely think in any of the, whether it's private credit or real estate or secondaries, all these areas, a 20, 25-year track record is really helpful.
Right.
And not everyone has it today in the private markets. We think the expectations related to transparency are no less in the private markets than the public markets. Institutional and high net worth clients expect us to provide them a significant amount of transparency.
Today already.
Today. So we don't think of what we do as changing that commitment to our investors.
What do you think about private opening up to more retail investors? And then does that change in terms of the transparency issues?
Well, so of course the growth that you referenced that we talked about on our earnings call at Ares, this sort of marriage of alternatives in the wealth channel is a secular trend, democratization of alternatives. That growth is being driven primarily by individuals with over $1 million to invest. In the U.S., that addressable market is in excess of 80 trillion and grew beyond that last year. So that's plenty to do. They all are still struggling to grow an allocation. Some of the limits on their allocations are where you're going, which is there are state limits on how much they can allocate. There or in some cases, federal oversight that limits the allocation. Individual banks have their own suitability requirements. But fundamentally, this high net worth individual that has over $1 million to invest gives us a massive runway to provide education and new solutions.
So you're referring to accredited investors, correct?
That's right.
There are some folks in your industry who say we need to essentially say we need to get rid of those rules about accredited investors because it will give more opportunities to folks to get in on deals early and have more upside. It doesn't sound like you're actually saying that. You're saying that accredited investors, there's enough dry powder there essentially for you.
No, I do think that over time, as we work to investors that even less to deploy lower sophistication, there's an opportunity to provide them solutions they don't get today. You know, a big part of what we do is not just raise money, but deploy it. And the fundraising and the growth in the private markets is, driving a lot of the headlines. But one of the things we want to make sure is it's deployed reasonably, thoughtfully. And Ares has got a real commitment to local origination, whether in real estate or credit or any of our areas. And we were talking before the call about how important it is to build portfolios with small single investments, so you're very diversified. ARCC, which is one of the largest public BDCs, the single name exposure there is 2.5 points. It's not a concentrated set of bets.
Really spread out.
And to build that type of a portfolio you need to be able to have a significant feet on the ground and origination.
Right.
So, but yes, do we think that non-accredited investors are a growth area for the firm? Absolutely. But we think we're in the early innings of the high net worth investor allocating more to the wealth channel, and there will be a time when non-accredited investors will also get access to what we do.
Raj, how much bigger do you think the private credit market gets? I mean, it's just an incredible kind of the explosive growth that we've seen just in the last couple of years. And you and I talked on the call in great context, reminding us that still the public markets are so much larger. But does it get to a point where the private markets rival, certainly on the equity side of things, or is that just crazy?
Well, I think it provides a really attractive solution. It's floating rate. In 95, 96% of the loans are floating rate. That's an important aspect because it minimizes the volatility that we've now seen with fixed income. Private credit is also higher yielding, and we're asked often, how much, what do we think of the growth? It's actually, the growth is not really outsized versus private equity. It just has gotten a lot of attention in the last few years.
Okay.
Think about any sort of typical LBO, you need 2 quantums of debt for every amount of equity. So to have a proper functioning economy, the private credit has really stepped in and addressed some of the concerns where banks don't provide as much capital, where you don't find other solutions.
There are some critics out there who say that, there's not the same oversight with private credit that there is with traditional lending through banks. Banks would like to say that. I'm wondering if on your radar there's concern that there could be more regulation coming for private credit.
I worked at a large bank for a while, and I understand that. There is not the same leverage with the investment managers as there is, or there used to be with banks. There's also an appropriate matching of capital and deploying it. So we have investors that provide us long-term capital, and it can't be called on the short term. So actually, the large players in the private credit markets are very, very different than banks when they were lending either at the peak or even after the GFC. They don't have the same leverage. You might have 1x leverage. They don't have the same volatility in the capital they're deploying. So it's a very different value proposition. It's not the same threat to the economy. We're not taking deposits from individuals and so on.
That was Raj Danda, Global Head of Wealth Management at Ares Wealth Management.
And that wraps up our first hour of the weekend edition of Bloomberg Businessweek from Bloomberg Radio. Ahead in our next hour, more from Bloomberg Invest held this past week in New York City, including getting really deep inside today's AI world with the Global Chief Technology Officer and Chief AI Officer over at Dell. And yes, we might even talk a little DeepSeek.
DeepSeek was actually one of the many things that Ben Wren and I spoke about at Bloomberg Invest. That's where he gave a demo of his Gen AI product, Magic. We'll hear a bit from that conversation and his predictions about the role AI will be playing in all of our lives in a very short time.
And keeping your eye on the ball amid market volatility. We'll talk about that with Goldman's co-head of Global Private Wealth Management. Our coverage from Bloomberg Invest continues. This is Bloomberg Businessweek.
You're listening to the Bloomberg Business Week podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business App. Or watch us live on YouTube.
Plenty ahead in our second hour of the weekend edition of Bloomberg Businessweek, as we broadcasted live from the Bloomberg Invest event in the heart of New York's financial district this past week. Coming up, another read on today's market and investment environment with Mina Flynn, co-head of Global Private Wealth Management at Goldman Sachs.
Plus, we mix in some technology, as many guests at Invest talked about the changing landscape of investing, the role of fintech, and yes, artificial intelligence. On AI, we'll hear from Ben Wren, the founder and CEO of SigTech, a company that's built a Gen AI product to analyze financial markets.
And John Rose, Global Chief Technology Officer and Chief AI Officer at Dell Technologies on DeepSeek, the great AI spend and build out and how companies are really using artificial intelligence.
First up, though, more on today's market environment and keeping your cool amid volatility. That was top of mind as we sat down with Mina Flynn, co-head of Global Private Wealth Management at Goldman Sachs from Bloomberg Invest. Our conversation on Tuesday was a day when markets were pretty volatile amid U.S. tariff concerns.
I think the number one thing that we have to remember is that when it comes to individuals, the first thing you focus on is portfolio construction. portfolio construction drives 90% of a client's returns. And it's something that we talk about upfront and then on an ongoing basis with them. And the reason why this is so important is in times of volatility, such as we've had this week. And what you don't want is you don't want investors to be taking so much risk that they become uncomfortable and they sell, they crystallize a loss versus staying put or buying. But on the flip side, we want to make sure that we encourage clients to take enough risk so that they offset inflation on an after-tax, after-spending basis. So our portfolios are really constructed with investment-grade, high-quality fixed income, and then a good amount of equities and alternatives.
Let's talk about the equities first. In terms of geographic exposure for those equities, what has it traditionally been? And look, we know it's not a monolith. Every client is certainly different. But in general, how do you think about U.S. equities versus equities outside of the U.S.?
Sure. So we prefer U.S. equities, and we prefer that both in both public markets as well as private markets. Big picture, we have roughly about a 40% allocation to public equities. The largest allocation of that is to U.S. equities. And then outside of that, developed international equities. We do have a small percentage to emerging markets. But then also, I would say we have recently increased our allocation to private markets and to private equity, and specifically as it relates to buyout and growth. And the reason why is because these are two subsectors of alternatives where you see a significant amount of alpha relative to public markets, and also the distributions of returns is much more narrow than other sub-asset classes within alternatives.
In terms of private equity, are you upbeat about the ability to start seeing exits, which is something that has been really difficult over the last few years?
It has been difficult as it relates to public markets. I'm upbeat as it relates to private equity on two things. One is I do think to the extent that you have opportunities right now in public markets to be able to take companies private, I think that's an attractive opportunity for private equity companies. Second, I do think that there's a lot of opportunities for private equity companies in the private markets. So they don't necessarily have to only think about taking a company public or M&A as their only alternative to liquidity. So a lot of secondary private equity funds, a lot of continuation funds. The other thing I would note, although, is if you look at growth valuations in private equity, what you have seen is you have seen a normalization of valuations between public and private markets. And the reason why is because you've had really strong performance with these portfolio companies, and it's allowed these companies to grow into the target exit valuations that these GPs were looking for. So I do think once you have a little bit more stabilization in the markets, you're going to see more deal activity, both as it relates to IPO as well as M&A. Okay, so let's talk about potential stabilization in the markets. Just in the last couple of weeks, we've certainly seen things change quite a bit. What's your outlook? So I would just, the thing that I'm really thinking about is the sequencing of policies. And so if you look at the Trump administration, it is a pro-business administration. But what we're seeing right now is some of the negative hits to growth come first, whether that's immigration or whether that's tariffs. Before in the second half of the year, we're probably going to see some sort of tax reform as well as deregulation. And so I think what we've got to be mindful of is a little bit of that curve. Generally, the number one driver of U.S. equity returns is a growing economy. Even with the tariff rates that we're talking about right now, we still do anticipate that we're going to have positive GDP in the U.S. And so from here, we still do see equity market upside in the U.S.
So, Mina, you guys don't think about recession because it does feel like all of a sudden the narratives change a little bit. We've seen weaker consumer spending numbers, consumer sentiment numbers, manufacturing data. So recession off the table completely for this year?
It's definitely not off the table. Okay. And we absolutely are looking, at the data. But you're also looking at a growth of over 2%, 2.5%. And so we have the odds of a recession, even with these tariffs, relatively low, call it 15 to 20%. I do think it's important just to take a step back and just look at, we've got an S&P that's down roughly 1%. Year to date, right? We've got a lot of volatility, but we've got an S&P that's down 1% year to date. Okay, where you've really seen that underperformance is in the consumer, to the macro points that you were talking about, as well as in technology, just because you've had some of the growth decrease in earnings outperformance versus, call it, the rest of the 493.
Right.
But outside of consumer and technology, all of the other sectors are positive. And so what I'm really focused on is the earnings path for the other 493. I think the Mag 7 is going to be fine, but what we're going to see versus 24 is likely a lot more earnings growth. So call it 3% In 24, roughly 8-9% this year. And so, and just to your point as it relates to tariffs, we anticipate that every 1% increase in the effective tariff rate decreases growth by roughly 10 basis points and increases inflation by 10 basis points. So it is manageable. I mean, it's going to depend on what happens, how long those tariffs are in place, if they're rolling or not. I think if they're rolling tariffs, it's going to be much more hard from an inflation perspective.
Do you think that's up in the air? Do you think that these are going to be lasting tariffs that stick around for a long time? Will there be more possibly? Or do you think that things could change in a week, in a month?
I think things could absolutely change overnight, in a week, in a month. And I do think that there's the opportunity to also make a deal with, Mexico, Canada in the near term and actually, have those tariffs reduced. And so I think the ultimate is we don't know what's going to happen. And the main thing we're focused on is that economic data.
Do you think that tariffs on Mexico and Canada are more damaging than tariffs on China? Because it does seem like the Mexico and Canada tariffs, there is this off-ramp when it comes to, what the president and his team have called essentially the border crisis and the drug war.
Yeah, I mean, I think
China, we don't necessarily see that off-ramp.
Yeah, when you look at 25% tariffs that you're talking about with Canada and Mexico, it's much more substantial than the tariffs that you've actually seen on China. And so when you think about that effective tariff rate right now, it's roughly about 8% if things stay as they have been announced. An 8% tariff rate would actually hit growth by roughly, call it, 80 basis points, and would increase inflation by roughly 80 basis points. That being said, we already had inflation coming down from where it is right now. And so we probably get to roughly a 3% level if that's the case. Again, it's not our estimate or our perspective that tariffs stay at these levels. But if that's the case, you still have an opportunity for the Fed to be able to react if you have inflation, even at that 3% level. And so what we saw in 2019 is the Fed cut as an insurance cut. And could we see that again today or, call it May, June, December? Absolutely. And I think the market's pricing more of that today.
That's exactly what traders are pricing in 3 rate cuts. What kind of blows my mind is, though, as you say, things could change quickly, overnight, in a week, in a day. And that's kind of the environment that we've seen. And we've seen it play out in terms of the rate environment. One thing I want to ask you, because I think there's been an assumption when it comes to President Trump, his tolerance of market volatility, that he was watching the equity markets. It was kind of interesting to see, I feel like, over the last few days where the markets certainly the equity markets had some problems. And we just had this assumption that President Trump would do something, say something. I'm curious what's the conversation you guys all have around that?
Yeah, I mean, definitely there
was the Trump put, whatever you want to call it.
Yeah, I mean, there's definitely the perspective that there was going to be a deal done, which is why, the markets are reacting like they are. And you do have a president that has really focused on pro-business policies. But at the end of the day, he's very focused on bringing manufacturing and jobs back to the U.S. And the question is, can we withstand that volatility? Can the consumer withstand that volatility? Can CEOs withstand that volatility and continue to invest in their businesses?
Before we let you go, Mina, crypto, is it part of the alternatives in a portfolio for your ultra-high net worth clients?
It's not part of our clients' portfolios. And the main reason that is because we don't see it as a store of value. It's very hard to actually value.
Oh, please repeat that for the crypto folks in the back.
Yeah. So
you don't see it as a store of value is what you said.
We don't see it as a store of value. It's a highly volatile asset. And it's hard under what valuation metrics do you actually value it? So no, we don't have it as a part of our core asset allocation.
That was Mina Flynn, co-head of Global Private Wealth Management at Goldman Sachs.
You're listening to Bloomberg Businessweek. Coming up, AI and financial services. The founder and CEO of SigTech stops by to share his magic. That's short for multi-agent generative investment copilots. Carol, say that 5 times.
I like it, though. Magic. That's next. This is Bloomberg.
This is the Bloomberg Business Week podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business App. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
A big theme at Bloomberg Invest this year, no surprise, was AI, artificial intelligence, specifically the monetization, it feels like, that we're all wondering and questioning around AI. How investors are extracting value from it, the risks, the opportunities across public and private portfolios, and where the smart money is moving.
On that, I caught up with Ben Wren, founder and CEO of the London-based fintech SigTech. It spun off of Brevin Howard back in 2019. It now offers a Gen AI tool called Magic. It's basically this group of AI agents that analyze financial markets. And Ben says work that would typically take quants and analysts hours to do, Magic can do in less than a minute. I spoke with him after he gave a demo to the folks at Bloomberg Invest.
We work with clients to focus on workflows that share a few characteristics. I would describe them as intellectual but not creative. For example, one of our biggest clients, they are using us to completely transform the commercial loan underwriting. To be honest, when you are the human professionals underwriting commercial loans, you don't really want to be creative. So it's a very intellectual but not creative endeavor. But it's very boring. The other one is it's very manual because, for example, on the commercial loan applications, each firm has to apply in their own format. There is no standard or template for the application. So each business just sending their documents in whatever formats that they feel comfortable with. It could be a motley pot of PDFs, slides, and Excel spreadsheets. And at this, I want to make one statement which is very interesting, which is in finance, we create documents and materials by humans for humans. So if you look at all these presentations, right, actually the most important information, we actually spend extra time to turn it into a graphic. Right? We want to visualize actually the most important information in our slides because that's how we make an impact on the human reader. But it turns out this information in that format is really not very friendly to large language models. So a lot of our efforts want to make sure that we can actually extract that visual information into a format that we can work with using large language models.
Ben, when I saw you using Magic, demonstrating it for everybody, there was a little font at the bottom that said something along the lines of, this is not investment advice, there could be errors in here, make sure to use independent research, something along those lines. Obviously, I'm not a lawyer. What is the risk with just taking what it spits out and pasting it and giving it to your boss?
I think for regulated services and businesses, the human will stay in the loop for the foreseeable future. The regulators, the entire regulation framework it's human-centric, right? So the regulators want to make sure that someone is staying in the loop and is accountable for the actions and consequences. So in these businesses, AI agents, they can automate a huge amount of work, knowledge work. We have seen people, used to spend 6 hours in processing loan applications. Now they only need to spend 30 seconds. That's 200x improvement in speed, actually makes a huge impact, but someone has to be there and supervise. That's why this user interface, UI design, is super important, because as we scale the capabilities of the intelligence, how do we make sure that the human is not overwhelmed by a new type of work?
But how do you know that what Magic produces is correct?
There are actually many ways to do it. First, as the large language models get better, they are more and more grounded. For example, the latest generations of reasoning models, they essentially have built-in self-reflection and self-critique. So the quality of the response is going up. And that's just mainly because of the pre-training and post-training breakthrough by the foundational model AI labs. But on the other hand, as we build Magic and build AI agents, we can actually build in grounding into it. So as the responses come back, we always want to provide citations, quotes, so the human can one click away from verifying it.
The whole idea behind a product such as this is to give you an edge over your competitors, to find that alpha. But what happens when my competitor asks Magic the same question that I asked? You'll get a result that's the same, and then you won't actually have that advantage?
I think if you ask exactly the same question, you'll probably get some very similar answers. But I do think the nature of the work going forward will become, each individual contributors will become a supervisor. I think that's a fundamental shift in the role, in how we do our jobs. I think today we go in there, most of us are individual contributors. But it's like the transition from a PhD researcher, PhD student to a supervisor, to a research director. The other thing is, I think people will ask different questions. I think people have heard about the phrase prompt engineering for a few years now, but it's surprising to me how difficult or counterintuitive it is to most people. I would say there is no substitute for spending 10 hours of your time on seriously learning how to have a productive conversation and try to push the limit of what this model can do or not do. I think the difference is most likely will come down to who asks better questions and who can follow up with better questions.
So it really raises the question, I think, in the financial services industry about what this looks like if it's widely adopted in terms of what it does to workforces and how it changes the way companies think about who they need to hire and who they need to pay. If this does the work that a quant can do in 45 seconds, that would take a quant, 3 to 6 hours, then what do the quants do?
I think the quants will find more interesting things to do. The truth is, I think, if you think about it, up to this point, the technology made a difference only in the field of what we call explicit knowledge, right? We automate stuff, but in order to automate, that knowledge has to be explicit, something we can write down, codify, almost linearly, and then we get people to implement it in Python or some other programming language, then automate it. But there's a huge amount of tacit knowledge that exists, especially in industries like financial services. That's why we have human experts. They are experts because they have knowledge in their head that's based on years of experience, but that's simply impossible to write down in a very codified, simplified way. But now with large language models and AI agents, what we have learned is that for the first time, we can use AI agents to distill these tacit knowledge from human experts into automated processes. I think that's where the breakthrough will really come from.
You told me in one of our prep calls ahead of this panel that by the end of this year, the workforce will likely be half human, half AI agents. You stick to that right now?
I think half, yes. I think by the end of next year, ratio will be, for each one of us, there will be multiple AI agents. So I think by the end of this year, we'll all be very familiar with the concept of a hybrid workforce. By the end of next year, I think that ratio will only keep going.
I mean, you're talking about a fundamental shift in the way that an economy runs here. Contextualize this moment in economic history for us. Is this like the Industrial Revolution? Is it like the rise of the internet and the browser in the 1990s? Where are we?
I think about this in terms of electricity. I think we are very close to a point where intelligence in terms of streaming tokens will be on tap, similar to electricity on tap. Now, I recently looked into it. I mean, it's quite interesting. In the last 200 years, each country on average spent about 1% of the nominal GDP on building and upgrading the electricity grid, even today. I think during the New Deal in the 1930s, the US spent about 1.2% of GDP on building out the power grid. Actually, the first power station in the US was built in Manhattan. So 1% of GDP today is about 300 billion. So coincidentally, this year, the big tech companies have already announced 300 billion of investment into data centers. So I think the investment is not over-investment, but it's quite shocking how quickly we ramped up the investment to literally this magic number, 1% of the GDP.
You did say also a couple of months ago to me that this tends to move in 3-month increments. The idea being the technological breakthroughs that we see are really happening so quickly, you have to think about the development of AI within 3-month increments. What's it going to look like a year from now?
I think for us to, given the 1% GDP investment, for us to really deliver the promise, we have to see something like 8 to 10% of GDP growth. We have to quadruple our GDP growth.
Here in the US?
Here in the US, in a world where the adoption for AI is really, China is very keen to adopt AI for pretty much everything. So And that's really when I say that's the promised land, that's the promised land, right? That's the promise we have to deliver given this kind of investment. I mean, just to illustrate how fast things have come. 3 years ago, to train the GPT-3, it only used something like a 15 to 30 megawatts data center. It was quite normal. And today, Elon Musk and Meta are building 2 gigawatts data centers, which is 10 times bigger. And for that to work, they have to build everything. They have to build their own natural gas power plant next to it. So the sheer scale of the investment is really unprecedented. But for us to deliver that promise, we have to see in the next 5 years a GDP growth of 8-10%.
You mentioned China, and I'm wondering about the country's ability to pull this off if there are export controls in place on American tech, such as we've seen with NVIDIA. Since we last spoke, everything with DeepSeek happened. How do you look at what's happening in China and whether or not they can become like a competitor to the US when it comes to AI?
I think to scale the intelligence, there are only a few variables. Number one, data. In China, the data privacy is much less a concern. And also there are many people generating data. So I would say China probably has an advantage in terms of having access to the quality, the quantity of the data. The second thing is just sheer talent. There are 200 papers in AI published every day. I read some of them, obviously not all of them, but one thing is very striking. You can open a random AI paper these days, about 30% to 50% of the co-authors are Chinese. So China has this big supply of talent. The same in the US. The last one is just compute. All else being equal, intelligence is basically the logarithm of compute. So you increase it by 100 times, you get 10 times better intelligence. So I think China and US are really the two countries in the world who are really pushing.
That was Bin Ren, founder and CEO of SigTech, from our panel discussion at Bloomberg Invest.
Still ahead on Bloomberg Business Week, more from Bin Ren and more on magic and how AI will affect financial services.
This is Bloomberg.
This is the Bloomberg Business Week podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business App. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
We're back with highlights from Bloomberg Invest held this past week in New York City. We want to get back to Tim's conversation with Bin Ren, the founder and CEO of SigTech.
Now, SigTech spun off of Brevin Howard back in 2019 and now offers this Gen AI tool called Magic. It stands for Multi-Agent Generative Investment Copilots. And here, Bin talks about the opportunity he sees for AI to disrupt financial services.
We're Bloomberg. We love numbers. I know you're still considered a startup at this point, but give us some numbers like how many customers you have, if you can, and where you're seeing it be deployed.
In the last 2 months, we built a lot of private proprietary versions for different firms, but I can't show you. So this one is actually 2 months old. So we are officially launched in September 2024. We started 2 years ago. We made a very big bet 2 years ago to say this is the future. We are going to, bet the company on this. Even that took us 18 months to figure out how to do it right. Because it's so new, unprecedented, we have to experiment, trial and errors. So we launched it in September last year. So we got into the hands of over 150 financial institutions. We are extremely excited about the use cases we are able to deliver. So we currently focus on 3 categories. Number one, macro market research. Just because my background is from macro hedge fund, I know the field very well. People think people use magic to get some magical insight, but funny enough, actually people find it extremely useful to have an understanding of where the market has priced in. Mm-hmm. It's kind of counterintuitive, but if you think about it, right, since large language models by construction always give you the most likely word one by one, so it's actually a fantastic tool to survey the market at any point in time, understand what other people know, how other people think about it, so what the market has priced in, which is the first step toward for hedge fund managers to figure out, do I have some view that's different and how to put on a trade. So number one category, macro market research. The second is equity fundamental analysis. So we did a big talk on this because in the last 10 years, the number of equity analysts has dropped by over 35%, whereas the public market has becoming more concentrated than ever before. So we have this very weird dynamic, tens of trillions of capital going to passive. Top 26 companies are responsible for half of the market cap of S&P 500. And I don't think people can name the other 474. So in some sense, we feel like the market has become less efficient, where we need analytical power to cover more companies, but we don't have it. So we're working with equity fund managers who have, by the way, who had a very tough 15 years, just because this concentration in the top stocks. It's not really stock pickers.
The S&P 500 has performed very well over the last
it's very hard to beat.
Or so. It's been tough to beat. You did recently write that AI is going to dramatically impact financial services in terms of cost structure and profit margins.
Yeah.
Give us some numbers there.
Yeah. So financial services, excluding payment globally, is a $20 trillion business, right? $20 trillion of revenue every year. And if we break it down, about $3 trillion of profits. But then, in terms of costs, we think $8 trillion of costs can be hugely affected by what's going on, by what we are building in GenAI. That includes $5 trillion of staff costs, $2 trillion of risk and regulation related, and then $1 trillion of tech spend. Right? So I think $8 trillion, that's just a starting point.
Are the financial firms that you're trying to sell to, or that are your customers, do you believe that they're being too cautious with their adoption of the technology?
I think they are being very cautious. But again, it's very difficult to make a very clear decision, because just given how things are moving, and it's very hard to get, I think especially in large regulated businesses, to make such big decisions, you need some kind of consensus building in the firm. But by the time you build a consensus in 3 months, things have changed. So I think that in terms of the adoption in financial services, I think it will start with a few firms with visionary leadership that embrace it. And given the speed at which we can implement it, I think within 6 months, they will be able to disrupt the market segment they operate in, and then that will have knock-on effect.
That's Ben Rand, founder and CEO of SigTech, during our panel discussion at Bloomberg Invest.
And we're going to stay with technology now to a guest who keeps us up to speed also on AI developments. Timely, considering this past week, OpenAI rival Anthropic officially closed a deal to raise $3.5 billion at a valuation of $61.5 billion, cementing its place, Tim, as one of the largest startups in the world.
With more on AI, where we are, and the great AI build-out and spend, we talked with Dell Technologies Global CTO and Chief AI Officer John Rose. He was at Bloomberg Invest.
There's two answers. In terms of AI spend, clearly that's a gigantic growth area. I think we've seen the TAM double in the last year. There's no doubt that we're on a track right now, and definitely in the global enterprise market, that probably the majority of IT spend in the long term is to build and implement the systems necessary to power the AI transformation of businesses. So pretty bullish on there. The consequences, in order to do that, we have to make the older systems more efficient. So there's actually a spend profile there of trying to densify environments and aggregate legacy systems. So the whole space is pretty active and looks to be a pretty positive environment, because without that infrastructure, there is no AI future.
John, we're like over 2 years in, at least, that the market, the world, as you always remind us, AI, nothing new. We do the same thing, but certainly the narrative and the discussion changed more than 2 years ago. How has it evolved here in 2025? What's top of mind?
Yeah, so we're in year 3. Year 1 was experimentation with some tools that people couldn't really use for enterprise. Year 2 was the do-it-yourself era, that if you wanted to do it, it was a big technical effort. Year 3, we've now seen lots of ISVs, lots of turnkey offerings, and most importantly, companies like Dell.
Wait, SIVs?
ISVs, independent software vendors, people who sell you stuff. So instead of do it yourself, you can actually buy stuff to do AI, which is incredibly important. The two things that we need for enterprise adoption are, one, the ability to consume it as a technology as opposed to a do-it-yourself project, which that's actually happening now. And the other is a feeling that you're not the first mover. And because some of us big companies have moved first and have gotten to the other side of productivity, now there's archetypes to follow. So I'm pretty bullish about this is a good year in terms of expanded enterprise adoption.
We haven't gotten to talk to you since the DeepSeek news on January 27th that really wiped hundreds of billions of dollars from NVIDIA's market cap. We're down on NVIDIA about a little over 20% since the January highs for that company. Are you seeing any pullback in the space right now?
No.
In a word.
Yeah, and the reason for it is, look, DeepSeek was just another of 40 years of disruptions that have progressively moved AI forward. AI was a theory 40 years ago, and then we invented things and created new technologies and bent the curve multiple times to ultimately get to where we are today. Today, there's only two levers that make AI better. One is the MIPS per watt of the compute environment.
Okay.
Every time NVIDIA delivers a new GPU, that gets better. And the other is algorithmic improvements, which are things like DeepSeek. And they just allow us to do things more efficiently.
So you buy what we know about DeepSeek? Like, are you skeptical that they were able to do what they did with the resources they had?
Look, I didn't have a front row seat to exactly what they did. I look at it as interesting engineering. It does look like some novel approaches using some existing technologies. Great, we need that. And what we've learned from it, because it's an open model, is, there's some interesting techniques that other people are going to adopt. And guess what? It's going to make the whole AI industry more efficient. If there wasn't kind of insatiable demand in front of us, I'd be nervous. But there is. We have barely touched the processes of the enterprises in the world, and we have millions of them to go after.
But I do wonder, to Tim's point, that does DeepSeek make us rethink the models or the narrative about how the build-out has to happen, the energy needs, this cost, whatever it is?
Yes, it just like every other iteration, we're in a world. Welcome to the AI Club. The AI Club is an environment where there's constant disruption happening, moving the industry forward. And so the novel approaches in DeepSeek allow us to rethink, hey, maybe I can do training a little more efficiently. Maybe I can do inferencing a little more costly. Maybe I can develop a different way of thinking about a model. Great, let's adopt that. Let's build on it. And the next one might be bigger disruption, but it'll still move the industry forward.
Got to ask you about Elon Musk and the government. Yep. And the goal is to make it more efficient. And there's, of course, a lot of news and a lot of headlines around what's going on in terms of what we've seen so far. What are your expectations that it becomes a more technologically advanced run government?
Well, I think, Elon,
and we should point out that Dell supplying servers to Elon's XAI.
And the government and everybody else in the world, we're very present.
You're there.
Here's the punchline. Elon's a technologist. He clearly understands the technology stack. The way you improve things, the way you get productivity, you do things better, is both the improvement of your processes and the application of technology to make those processes work more efficiently. Both of those are going to happen. I can't tell you exactly what's going to happen in the government. I can't tell you which play they're going to make, but what I can guarantee you is the end state, there will be more technology powering our government and our public sector, and it will probably make them more efficient and more effective. How it works out above my pay grade, but it is inevitable. The one thing I can guarantee you, there won't be less technology in the government when we move into the next year or the next 2 years.
Listen, I'm asking you this as a technologist, as somebody who has a front row seat on the technology side. Critics have said there are concerns about security and privacy when it comes to what Doge and what Elon Musk are doing. Should they be concerned?
Maybe. You should always be concerned, and you should always look at the risk of technology. Here's a good example. We're maybe outspoken that for the real critical AI activities, you should do them in a private environment. Some people disagree with us. The reason we say that is because that's the lowest risk path. It also happens to be the lowest cost path. Every technology decision you make is a technology in a vacuum until you apply it to a real world scenario, and that's where the risk comes in.
So essentially what you're saying is if the Department of Government Efficiency employees are using AI tools to help with their jobs, they should be doing that in an environment that is secure.
You bet. And what that means to them, they should figure out. But what you shouldn't do is go into an environment when you're using technology without contemplating the risk of it. I have full confidence that any good technologist, including the folks doing that work in the government, are absolutely thinking about not just the technology in a vacuum, but the fact that when it gets into the real world, there are security considerations, there are other activities that need to be controlled, and you always build a security model into your technology architecture. Even LLMs have security models. Even agents have security models because that's necessary to make them work in something like like an enterprise.
Our thanks to John Rose, CTO and Chief AI Officer at Dell Technologies.
And that wraps up the weekend edition of Bloomberg Business Week from Bloomberg Radio at the Bloomberg Invest event in New York City. You can catch all the conversations from the events, including Tim's demo with SigTech. You can find that on the Bloomberg and at Bloomberg.com, including the Bloomberg Live website as well. Thank you so much for joining us.
Be sure to tune in to Bloomberg Business Week Monday through Friday starting at 2 p.m. Wall Street time on Bloomberg TV, Bloomberg Radio, and on Sirius XM channel 121. You can also listen to us on Apple CarPlay and Android Auto free in the Apple App Store or on Google Play.
You can also watch our daily broadcast on YouTube. Just search Bloomberg Global News. We're simulcast on Bloomberg Originals, available at Bloomberg.com/originals, and streaming platforms including Roku, Amazon Fire TV, Samsung TV Plus, and more.
Find our Bloomberg Business Week podcast at Bloomberg.com, Apple, or wherever you get your podcasts. And the latest edition of the magazine is available on newsstands now at Bloomberg.com and always on the Bloomberg terminal. I'm Tim Stenovec.
And I'm Carol Massar. Have a good and safe weekend.
This is the Bloomberg Business Week podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business App. You can also watch us live every weekday on YouTube and always on the Bloomberg terminal.